different is the Indian stock market from the US market in terms of leverage and financials? SEBI regulations on limiting leverage in strengthening the domestic equity market. In the stock market, the amount you invest can make you richer in long run but can leave you with nothing in a short time. The intensity of the fall magnifies because the guys who are leveraged will either have to bring in their mark-to-market losses or square off their positions. And when the markets are in a bearish phase, people squaring off positions creates a really large impact. That's what happened in the USA from March to June this year. The last bit of the fall was leverage being unwound really fast. In India, they did not have that problem this year because there was hardly any leverage, be it at the customer level, broker level, or the entire industry level. There were hardly any forced #leverage square-offs, which meant that when other markets fell we fell less. And as it bounced back, we are almost close to all-time highs. When there is less leverage in the market, it creates less foam on the upside and less fear on the downside. Until 2010 or so, it was essentially almost unlimited leverage. Based on his judgment, the stockbroker could allow you to buy as much as you want. For example, with 1 rupee lakh you could be allowed to buy for 1 rupee crore as long as the broker is okay with the risk. Today the broker cannot even fund customers beyond 60 to 70%. If you buy 1 rupee lakh worth of shares of Reliance using margin funding, you need to have at least 20,000 rupees with you. The maximum leverage you get is 5 times. One of the main reasons for the 2008 crash was leverage unwinding. Brokers gave high leverage because they could make money in 2 ways. If you buy stuff for 1 rupee crore with 1 rupee lakh, your brokerage fee is on 1 rupee crore and not on 1 rupee lakh. The second was brokers could also charge interest on the money lent. Besides, the broker also did not have to bring his own capital because they could lend one customer's money to another customer. It was a very risky proposition of sorts. Today, the maximum leverage is 5 times, the broker has to fund from his own capital, and you cannot use one customer's fund for another customer. The regulations have changed drastically in the last few years.